On today's episode, we are going to take a look at one of my favorite stocks out right now. This is one I can easily say is one of the top 5 growth stocks for growth investors right now, and that is C Limited, ticker SE. And this company just reported earnings and is up 8.7% after earnings, and that's after having a nice run up for the past few months. And today's episode, I'm going to break it down into the following. First, if this is your first time learning about C, I'm just going to do an introduction on C stock, what they do, what type of markets they hit. Then after that, we're going to take a quick look at their earnings, just quick results, take a look at their future expectation growth, and take a look at their past growth as well. And then I'm going to take a look at their earnings highlights, take a look at some financial documents, and at the end I'm just going to give my thoughts on the company. And if you are new to my channel, if you are a long-term investor, and if you like to learn about growth stocks, make sure to hit the subscribe button. And you know what, actually that's my usual intro, but today I'm gonna say screw it, I'm gonna talk my ish right now. So C is a company that I've been talking about since May. Early in May I did a talk about it, how it was in my portfolio and it was sitting below $100. I have posted more videos about C throughout the time. When it was 120, when it was 115, I have posted a lot of information on C. And C is not the only one. I talked about Spotify when it was below 150. I talked about Huya plenty of times when it was in the 14s, in the 15s, in the 16s. I've talked about Space when it was in the teens. I've talked about apps. Many people don't know about apps. It's gone 100% in the past few months, and I've talked about it there. I talked about, what else have I talked about? I talked about Celsius when it was in the 11s. Right now it's sitting in the 22s. I've talked about Google and Facebook when the whole drama with them was coming out. And there's so many more that I can name, and I'm not trying here to brag. It's just, and I'm not here trying to brag at all. I just wanted to talk my ish, because seeing a company like this being up 8%, seeing my Spotify up 100%, seeing Fastly, DocuSign, seeing all these companies that I have talked about in the past month, just in the past months, have done amazing. And like I said, even though I'm new to this YouTube stuff, I'm probably about a year old in this YouTube stuff. I've been investing for about 6 or 7 years. So if you want to learn about growth stocks, if you want to learn, if you are a long-term investor, make sure to hit that subscribe button. And that's it. That's all my ish. Let's get this episode started. And you know, I'm saying all this, and it's not like I'm trying to sell anybody anything, right? Over here, all the information that I provide, it's free. I have a Discord channel. I don't have a private Discord channel. I have a Discord channel which is free to anybody that wants to join. I have a newsletter. You can hit me up on Twitter. You can hit me up on the YouTube comments. You can hit me up wherever. All the information that I provide here is free. I will not charge you guys from anything, because at the end of the day, I am by no means a professional, and none of this should be taken as advice. My past results does not mean anything compared to my future results, and everybody should understand that. And like I said, I have also taken a nice amount of losses, but those losses do not over trump my winners. And that's the great thing about investing. You don't have to have every single winner in the market. You can have, even if you have some losing stocks, if your winners keep on winning, those are gonna overthrow your losers. And like I said, I'm here for the long-term game, and I'm just happy to be able to share this with you guys. So thank you so much for everybody that's supporting. All right, so first let's just start off with the price performance for this company. Right now, C is sitting at $145, and it has a market cap of about $62 billion. And I still believe right now it's still undervalued compared to the markets that it's hitting, and we're going to talk about that in a bit. And in year to date, C has returned 264% to investors. And before we begin, take a look at who sponsored today's video. Today's episode is sponsored by my friends at 7 Investing, where every month they provide their top 7 stock market recommendations for only $17 a month. They already provided their August recommendations, so make sure to click on the link below. You can find it on the description or in the pinned comment for more information on this great team. All right, C is a Southeast Asian company. They are in 3 markets. The 3 markets that they're in is pretty simple. They're in digital entertainment, which is gaming, esports, and other social platforms. Then they're also in the e-commerce world with Shopee, and they're also in the fintech world with C-Money in the digital financial service. So they're hitting three markets that right now are just booming with the way the market's going, right? Gaming, if you guys gaming, the closest thing I want to say would be an Activision. Shopee would be the e-commerce version of Amazon, and then C-Money would be similar to like Square or Cash App or PayPal. So they are in three markets right now that are just booming right now. So that's pretty much all you need to know about C. The main areas that they hit is Southeast Asia, Taiwan, Singapore, Indonesia. Some of their applications, for example, their Garena, their digital entertainment hits other markets as well. It hits India, it hits Latin America, and these are places that they're seeing strong growth in. All right, so let's start off by taking a look at their earnings results. So see right now, they reported earnings August 18th, early morning. They reported quarter two GAAP earnings per share of negative 68 cents, which missed by 3 cents. And it might be like, Jose, why the heck are you showing me a company that's not making money right now and they actually missed earnings per share? And how are they even up 8% after missing their earnings per share? And that's the great thing about growth stocks, right? We're going to take a quick look later on at the future growth of this company. But normally with growth stocks, when you start off, you're going to start seeing high revenue growth. And as the years progress, they're going to start getting better earnings per share as things can continue to get better, right? Amazon is the perfect example. Amazon was not making money for numerous years. As things continue to progress, as they become more of a market leader, they start to collect more earnings, more revenue, and it starts to become positive net income. And that's what the expectation is with most growth companies. We can see revenue for this company for this quarter was $1.3 billion. That is up 94% compared to the same time last year, and it actually beat expectations by $230 million. And that's the important part, right? Even expectations, if you guys don't know, analysts every day or so, they might update their expectations. So even though we have seen previous companies like Amazon, like Mercado Libre, all done amazing in revenue growth, analysts that update almost on a daily basis still were not correct with their analysis. So it is still impressive that C was able to beat the expectation in revenue, even though so many e-commerce companies have already gone through. Quarter two adjusted earnings, and this is before all types of expenses, was actually positive 7.7 million. And this was better than the overall expectations of a negative $41 million loss in adjusted earnings. To me, I'm not a huge fan of adjusted earnings. I really worry more about GAAP earnings per share, and I just want to see the overall trend over years. All right, so next I want to take a look at their future growth. What is C expected to do? The first thing I'm seeing is C is expected to grow its revenue dramatically, over 28.6% on average annually for the next 3 years, right? This doesn't mean for the next 3 years it's only going to grow 28.6%. Maybe year one it might grow 80%. Maybe year two might grow 15%, and maybe year three might go 10%. I don't know if that math adds up, but on average for the next 3 years is expected to grow 28.6% annually on average. And that is what we call a growth stock. So growth stock, many people consider a company that's growing its revenue annually over 20%. And this is growing faster than the industry, and it's growing its revenue faster than the markets. Next, let's take a look at their earnings. Their earnings are also expected to grow a lot faster than the market. But unfortunately, remember, I told you this company right now is not making money. So usually when you're not making money, it's a lot easier to grow your earnings, right? You can go from negative 10 cents to negative 5 cents to 0 cents a lot faster than probably going from 0 cents to 5 cents to 10 cents. So one thing is this company is not expected to make money anytime soon. But it is expected to be profitable by the end of December 30th, 2022. So that's about 2 years from now, right? And it depends on the type of investor you are, right? For me, I don't mind investing in companies that are high growth in markets that are seeing strong growth throughout the upcoming years. I am very bullish in the e-commerce. I'm very bullish in the fintech. I'm very bullish in the gaming. So for me, this is hitting all the marks. It is also expected to be profitable in less than 3 years. That's usually my cutoff. If you're not going to be profitable within 3 years, there's a few exceptions, right? But if you're not going to be profitable within 3 years, then it's time for me to go on to the next one. So right now we're seeing strong expectation growth for SE, and it's expected to be profitable in the upcoming years. Next, I wanted to take a look at past growth for this company, and we can see SE has been just a monster in the past. In the fiscal year of 2019, it grew its revenue 161% compared to 18. In 2018, it grew 100% year over year. So in the past 2 years, it has doubled, each year has doubled its revenue nonstop. And just this quarter again, it did it one more time. And if we take a look here, I was talking about the gross margins, right? At the moment, this company, if we take a look at GAAP earnings per share, it's still unprofitable in the past 3 years, but we can see their profit margins are improving over time. And here, let me actually show you guys a perfect example of what I expect growth companies to do. This is Square. So Square, you can see, right, originally Square was not profitable. Things begin to change and they start to become profitable. Its most recent full fiscal year of 2019, it became profitable in GAAP earnings per share. So this is what you expect growth companies to do that. And this is what you consider a growth investors. Investors that don't mind paying right now for a company that is expected to grow later on. All right, so now let's take a quick look at some of the highlights for this earnings. The first thing we want to see is, like I mentioned, revenue for this company was close to $1.3 billion. And this is pretty much broken down into two segments. The first segment is called the digital revenue, and that made up over half of it. It made up $716 million of that 1.3, and that's up 62% year over year. Then we have their e-commerce, which grew 189% year over year and is up to $510 million. The total gross market value of items sold was up 110% to $8 billion. And that's super strong for e-commerce. That GMV value means the amount of products sold throughout their products. So what's the best metric you can see that a lot of people are buying in your e-commerce website, that a lot of people are selling? It's by seeing the amount of value of gross value being sold in there. And for it to be up 110%, it means it has doubled the amount of products, maybe not the products sold, but the money transferred in the past year. Cost of revenue has also increased dramatically. Cost of revenue is up 101% and it's up to almost $700 million. And that's a huge portion, but right now it's partially driven by an increase of logistic costs related to the e-commerce growth. And this is one thing I want to say. E-commerce right now, there have been many companies out there. We have Amazon, we have Mercado Libre, we have so many different market stories, right, that show that this e-commerce market works. Right now it is pretty, starting off, it ends up being pretty negative, and margins are usually pretty low, but they are profitable. And right now what C needs to do is make sure they continue to be the leader, because as you continue to see this growth, you're going to continue to see those profits in the future. So I actually wanted to take a look at their earnings call. There's there's some things that I thought were pretty interesting in their call. And let's see, I've highlighted them for you so we don't have to take a look at everything. The first thing I want to tell you guys is they mentioned that even though the markets that they're hitting right now, most of those markets have had the social distancing or the strict lockdowns have been lifted in the middle of second quarter of this earnings, they are still seeing huge growth on it. So a lot of people are saying, Jose, once everything starts to go back to normal, these companies are gonna fall back to where they were at. I do believe there might be some form of rubber band effect where they're pulling away too hard right now, and eventually it might pull back, but I don't think it would ever go back to the moment it was in March. Now these companies from e-commerce, from e-payments, e-gaming are gonna be ahead of their time. And that's what we're seeing. That's what they're seeing right now. As things are being lifted, as restrictions are being lifted, they're still seeing huge demand in the second half of the quarter, which had the lifting already happening in their markets. The other thing I wanted to mention is a lot of people were asking about C and what makes them different from their competitors. And they do mention that they are the leader growth within their market. And this gives them a lot of opportunities. They are a leading growth, so they're growing super fast. What does them growing super fast means? It means private investors. It means other investors are more willing to invest in them than in their competitors. This allows them to have more room to collect more money and to continue to reinvest in themselves, right? It's a turning wheel, and that's what we're seeing with C. They're grabbing that money, they're focusing on reinvesting themselves and growing that market and growing the market until that wheel becomes super big and they become super profitable. Another thing they see is another question that was asked was, what makes their digital financing service, C Money, different from all the other competitors out there? And this I thought was an amazing response. They said that yes, there's other competitors out there and they're doing okay. But C Money is integrated with Garena, which is their digital services, and it's also integrated within their Shopee, which is their e-commerce. So there's so many more uses for their C Money opposed to just e-wallets, that more people are coming into those markets as well because there's so much more uses for it. And again, that continues to have that wheel spinning. And I think those were the two questions I thought were pretty interesting, to say none the least. And like I said, if you guys are enjoying the content that I provide, make sure to hit that subscribe button. All right, so next we're taking a look at their presentation, and we already talked about a lot of the stuff. I just want to show you a little bit more of their growth. So first, in their digital entertainment user base, you can see in second, they grew their quarterly active users grew 61% compared to the same time last year. Their quarterly paying users also grew 91% compared to the same time last year. We can see gross orders for their e-commerce grew 150% compared to the same time last year, and their GMV grew 110%. This is just a ridiculous growth stock. And let me say, right, companies like this with growth stocks tend to be very volatile, and that's okay with me. I am here for the long-term game. So even if the stock pulls back to $100, I might sound selfish right now, but I would not mind that. I would use that time to build up more shares, to build up my portfolio even more with C. And like I said, I don't mind the volatility. As a long-term investor, it's funny. The only time I'm ready for that stock price to be up dramatically is when I'm ready to sell. Before then, I wish the stock price stays down so I can continue to buy. And look, this is like I was mentioning how their C Money is integrated with other platforms. In Indonesia, 45% of the gross orders that they had on their e-commerce Shopee were paid through C Money, their fintech. So that just shows you the power of their mobile wallet and the growth in there. And actually right here, all right, so now let's take a look at their financial documents. First, let's start off with what we call the income statement. Then we're going to take a look at their balance sheet. And the income statement, we're comparing it right now compared to the same time last year. And I want to show you guys this growth happening within this company. First, I want to show you the amount of revenues broken down by products and the cost that those revenue is made. Let's take a look at a year ago. A year ago, they made about $229 million in digital entertainment. That 229 costed them about $100 million for that profit. So that ended up giving them a gross margins in digital entertainment of close to 120 million. Let's take a look at this quarter in service revenue. Service revenue grew by over 150 million compared to a year ago, but their cost of revenue only grew by about 60 million. So now their gross margins increased, their gross profits for their digital entertainment is a lot higher, where last year I mentioned they were 130. This year they're more like 230. So you can see that strength of their digital entertainment. Now let's take a look at their e-commerce. Their e-commerce back then was their e-commerce and other services last year's revenue was 165 million. The total amount to make those sales was 198. So it was completely negative, a huge percentage negative. But let's take a look. This year is 364 million, and it costed them 388 million. So we can see the more they start to sell, the closer they get to becoming profitable, and that's the strength of right now them pushing that wheel that I've been talking about. We can see they have increased their expenses. They're spending more money on sales and marketing. Here, they're spending more money on advertisements, on influencers. They're spending more money on general administrative. They're growing, so they need more employees. They're spending more money on research and development. They have to spend more money to make more games, to make sure that the logistics of their e-commerce are doing well, to make sure the integration within their other platforms, with all their platforms, are working bug-free. So this growth here, even though most people don't like to see expenses going, unfortunately, they are in a market that you have to keep spending money. You have to keep innovating to make sure you become a profitable company. All right, so now let's take a look at the balance sheet. This, for me, is my favorite document to take a look at. I feel like you can learn so much here. So the first thing is we're comparing this to about 6 months ago, which was their end of the fiscal year of 2019. The first thing I see is there was a nice boost in cash by about $300 million. There was also an increase of about $240 million of restricted cash. And this restricted cash tells me one thing, that this company most likely did some form of offering. They most likely did some form of senior notes to be able to increase that cash. So then we can see total current assets is not something I'm too really worried about. It did increase. The most of it is coming from cash and cash equivalents, growing by about 300 million, and restricted cash growing by about 240 million. So that's about a 500 million increase there. There have been other increases here. The prepaid expenses. So prepaid expenses grew 300 million compared to 6 months ago. And this just means that they're paying their bills a little bit earlier. So we're not going to see that expense anytime in the future. That's good to see. Total assets has increased by about $1.4 billion compared to the same time last year. Unfortunately, we can see most of it coming from that cash that we saw up there, but we see a huge increase of goodwill, which to me is fake assets. That increased by about $200 million. But still, an increase of about $1.4 billion in total assets compared to just 6 months ago. The next thing I want to take a look at is their liabilities. So even though we saw assets increase by 1.4 billion, the last thing we want to see is total liabilities not increase by that same amount of value. And obviously, if we looking at it now, that was actually a bad thing to say, right? Because total liabilities have increased by $1.7 billion. So you might be like, Jose, holy smokes, they're growing their liabilities faster than their cash, than their total assets. This is horrendous. And the first thing I want to say is deferred revenue. Deferred revenue is money that has come in, but it has to be in a liability real quick. I can explain this a little bit better. Let's take a look at Netflix. So let's say Netflix, right? You pay Netflix a 12-month subscription, but you've only used them for 1 month. So deferred revenue would be that 11 months that they have yet to provide your service for. So some form of subscription service is deferred revenue. But look, that makes up $400 million in there. And in non-current and in current deferred revenue, that makes up $1.3 billion of liabilities is deferred revenue. That to me is fake liabilities. So at the end of the day, deferred revenue, taking a look at both current and past and long-term deferred revenue, makes up close to $1.7 billion. So that means that this company's total liabilities is a lot closer to $4 billion. That to me is a huge change, and that's a great thing to see. But we can see, right, this company did take more convertible notes this past year. This convertible notes is a way companies take out loans. So that increased by about $700 million this quarter. Again, I'm not against that. A company growing its debt right now as it continues to grow. But certain investors might, and that's understandable. Every investor has a way to invest and continue to do you. All right, so that's it for today's episode. Right now, let me just give my quick thoughts on the company. First, C is, to me, one of the top 5 growth stocks easily right now in the market. For me, I do believe I'm going to continue to add even as it goes up. but 100% sure if it drops, if it dips, it's one I'm putting. If I don't have cash available, I don't mind selling out of some positions to increase my position in there. At the same time, let's say I wasn't. A lot of people might be asking this. Let's say if I didn't have a position in C, how would I play C? I dollar cost average on a weekly basis, right? I don't have unlimited funds. So every week I put like $500-$600 in the market on a weekly basis. So for me to go in all at once is almost impossible since my money is always working. So with C, let's say I believed it was overvalued. At the moment I don't. I would do that. Every week I would put X of that amount of money that I'm putting into the market into C and build up my position over time. Some weeks I might buy high, some weeks I might buy low. To me, that's my preferred method because I just don't think I have the guts and the stomach to go in at like 20% of my portfolio at once. Because, right, if you go 20% at once, yes, if it goes up dramatically in a day or in a week, you might feel amazing. But if it trickles down, and most of the time I'm wrong and it's gonna trickle down, I'm gonna have to see my portfolio go down. So to me, I don't mind dollar cost averaging. Again, different investment styles for different people. All you need to understand the type of way you invest to go. Remember, at the end of the day, none of this is advice and this is just my opinion. But C is in the markets that I'm completely bullish on: the e-commerce, the e-gaming, and the fintech. So I hope you guys enjoyed today's episode. Like always, take care, have a good night, and see you next time.